guys. Today we're going to talk about market cap versus enterprise value. So that means that we also are going to be talking about um, PE ratios versus EV ratios. So let's go. Both ratios are useful as a quick evaluator of a company's relative price within its industry. And as we know, it comes from the following formula. P ratio is equal to market cap divided by net income. You can also use per share values. I don't like to use per share values, but we'll leave that one for another podcast. EV ratio is similar to this one. The only difference is that instead of using market cap, you use enterprise value. And enterprise value is calculated by starting with market cap. Then you add all debt to that and subtract cash and equivalents to that. That means that if you were to buy 100% of the company, the public company, whichever one you are talking about, you would not be paying market cap value. You would be paying enterprise value because you would also inherit all the debt and the liabilities that company has. And the same goes for the cash. You would also be buying the cash that the company has. You can follow all these formulas in the written posts, and that's in stockpickinginsights.com. Let's now go to a case study. This case study is interesting because there's a big difference between market cap and enterprise value. Let's dive into it now. The company I'm talking about is a Portuguese public company, and its name is Cofina. It's a media company, and by the time of writing, Cofina's market cap was 27 million euro, and enterprise value, which is again calculated by starting with market cap, so 27. Then you add all the liabilities, total liabilities, which is 94 million euro. And then you subtract all the cash that the company has, cash or equivalents, which is 17 million. And that gives you a total of 104 million euro. That's a huge difference. So 27 million market cap, 104 million enterprise value. We now take these two values and calculate both P ratio and EV ratio with it. But let's not forget that to calculate these ratios, you need to divide by net income or on a per share basis, EPS. I like to use softened net incomes if you are a listener of this podcast. So in this example, I used a 3-year average net income. Which we will approximate to 5 million a year. And if you use these values, you will arrive at a P ratio of 5, but the EV ratio is 21. That's 4 times higher. That's a huge difference. This huge difference doesn't always happen, so it happens in this case, in this particular case, because this company has a lot of debt in their balance sheets. If you take, for example, Facebook, their EV ratio is even lower than their PE ratio because they have liabilities, but they have even more cash, and that lowers the enterprise value compared to market cap value. Between these two, I'd rather use enterprise value and EV ratio as a consequence. I do think that this one better represents what you're buying because market cap doesn't account for liabilities. And because I'm conservative, that's an extra layer of security I have in my valuation. So that's it. We'll see you again next week. And if you'd like to check the written version, you just go to stockpickinginsights.com and we'll see you next week.